Welcome to the Remarkable Retail Podcast, Season 11, Episode 4. I'm Michael LeBlanc.
And I'm Steve Dennis.
On this episode, another edition of our popular new franchise, The Analysts, where we bring the sharpest minds and the retail industry's most respected thought leaders together. Sucharita Kodali, Vice President Principal Analyst, Forrester Research. Neil Saunders, Managing Director, GlobalData Retail. Welcome to both of you. Thanks again for joining us. Our third blue flame thinker, Simeon Siegel, former retail analyst at BMO Capital Markets, is off on gardening leave. So we all wish him well with his future endeavors. Go ahead,
Just
Steve.
more airtime for Sucharita and Neil. So
that's right.
It's not all bad.
Right.
It's not all bad.
Well, we get the pleasure of both of your companies. So we're going to jump right in. So once again, we're going to cover a bunch of key stories and get your insights on it. And I'm going to start. Steve, I want to throw to you about the news of the week. Story one. Take us there. Get us started.
Yeah. So we're going to we'll do kind of a hot take on something from the past week, and then we're going to get into some broader themes. So the first story I wanted to talk about was in the past week or so, we got U.S. monthly sales reports from two sources I think that have become pretty respected over time. The NRF CNBC Monitor, which importantly uses MasterCard actual transactional data. So rather than it being a census survey kind of thing, it's actual transaction data, a little bit of a skew, of course, based upon its being MasterCard holders, not the population at large. But we've got that. And then something that's been around for a long time, the US Census Bureau. And I think, most people's take on, even though the results were slightly different, I think most people felt like overall, the sales were perhaps surprisingly strong, given some of the headwinds that we've been talking about, tariffs, et cetera, consumer confidence. So, Neil, I know you look at these numbers pretty deeply, including at the category level. So what struck you the most about these, and just, I guess, your general take as to what's going on?
Yeah, I think what was interesting about them most of all is that they were pretty strong. I think they were surprisingly strong. But of course, both sets of numbers report values. It's the value of sales. And of course, includes inflation. And when you strip out inflation, the overall growth rate is about 0.4%. So actually the volume growth rate, it's still there, but it's not fantastic. So I think that's the first thing to say. You really have to think about these sales results in context. The other thing that was quite surprising and actually was pretty strong was the online sales number, especially from the Census Bureau data. They had year-over-year growth, I think 8.2% of non-store, which includes things other than online, but is mostly online. That was actually higher than the previous month, which is surprising because the previous month had obviously Prime Day and lots of other online deal days in it. But it could be because obviously, de minimis was coming to an end. People could be trying to get those digital orders from overseas in early before that came off. But overall, it was a reasonable set of numbers. And the question is, of course, do we go into the holiday period and see a continuation of this, or does it slow slightly? So I think it's an interesting setup for the golden period.
And what do you think? What's your take on the numbers, Sucharita?
One thing that I think is always important to remember is to recognize if these numbers are month over month or year over year. And often the press releases, in particular from the Census Bureau, are typically month over month releases. And that is, I think, such an irrelevant number because, when you compare month over month.
You're in a safe space here, Sucharita.
But when you're comparing like January to December, like that, of course it's going to be negative. It just doesn't even make sense. So what is much more important is to look at the year over year number, because that tells a bigger story as to how you performed versus, kind of a comparable month in the past. Now, granted, there are sometimes variances because, a particular day, like the day that Christmas falls on may be different, and that can affect your numbers. But for the most part, it's that year over year. And the year over year numbers have not only, to Neil's point, yes, they may be softening, but let's remember a couple of things. One is that let's compare it to like 5 years ago. And the numbers are enormous. Even inflation adjusted, these are the highest spend levels ever. We saw, as a retail industry, such acceleration between 2020 and 2022, 2023, that it was really, really hard to comp. Like that is, I think, essentially the Target story. Like Target had so much growth over the last few years. It was the first time ever that it became a $100 billion retailer. For it to comp those numbers is just really, really hard. And I think that's what we're seeing in retail. The other thing where I think that people think that retail should be doing worse than it is when you look at consumer confidence figures. And consumer confidence is terrible, right? It's in the toilet. It's like one of, kind of in the last 60 years, it's probably one of the 3 worst periods of consumer confidence. In spite of the fact that the stock market's at an all-time high, wages are high, unemployment is low. So why is that? And the answer that I give people, which I think is valid, is that in this era of social media, we no longer can equate consumer confidence to the state of the economy. The consumer confidence levels are related to your news cycle and what people are seeing in their filter bubbles, which is totally different. So we have to stop looking at things like consumer confidence as a reflection of the economy and start looking at macroeconomic indicators instead.
Yeah. The other thing I wonder about just in general is, and you've probably seen some of this data, the newest data, though this has been a trend for a while, is the increasing percentage of growth that is accounted for by the very top incomes. And so the other thing I wonder about is if you have, I think it's like 4% of all households drive like 20 or 25% of spending, and the top 10% drive 50% of retail spending, right? So those folks may be very confident because they're not getting squeezed by inflation or worried about losing their job, and their stock market and their house values are high. But as you go down the economic scale, for the larger percentage of people, that's why I sometimes say the consumer resilience thing is maybe a little bit of a myth. It's incredibly resilient if you happen to be very wealthy or at least affluent, but maybe not so resilient and you're not so confident more broadly. Any thoughts on how to think about that? Because I think ultimately, if you're a retailer that serves the bottom, say 60% of the population, maybe things are pretty tough. If you're Hermes, things look pretty good.
I think that's true. But I think it's interesting because even the kind of retailers you might consider at the bottom, the value retailers, a lot of their growth actually is being driven by the higher income consumers. I mean,
right.
Walmart
trading down,
yeah, exactly, of higher income consumers. Retailers like Five Below, exactly the same. There have been more higher income consumers trading down just to save money. They may not have to, but they want to be savvy. So actually, I think that higher income consumer is driving a lot of growth, but it's also driving it in unsurprising places, perhaps. If you go down right to the bottom of the spectrum, obviously with changes to SNAP, general inflation, the inability to get the kind of earnings up, I think there are real problems. But to your point, Steve, they are masked by the fact that actually there's a lot of other spending dynamics that power retail ahead. So I think it's a very interesting dynamic, but nevertheless, the overall numbers do look good.
Sucharita, I want to follow up on something, and Neil, you got me thinking about something as well. Sucharita, when Steve and I have been talking about this consumer confidence, it's actually not incredibly new that the confidence isn't well correlated to retail sales. Do we have that right? I mean, you make an excellent point that it's particularly bifurcated today, but it seems to me like that's historically been the case. Or am I wrong? Have you seen historical data that you can have some kind of closer prediction about retail and consumer confidence?
I think that historically, I mean, even dating back as recently as probably 2010 and prior, usually you would see if consumer confidence were lower, it was typically during periods of recession. And what is unique now is that we have really, really low consumer confidence that is comparable to recessionary times, but we're not actually in a recession. Like the last time that consumer confidence was as low as it was like 2008. Now, what's interesting, when you look at like YouGov economist data, you'll have a huge percent of people who, depending on who is the president, will actually think we're in a recession, even though there's no, no determination that there's a recession. The Fed has not declared a recession. Nobody has declared a recession. A recession is like subsequent quarters of negative GDP growth, essentially. And we don't have that. So but yet people think that, which again goes back to the news cycle and filter bubbles and misinformation.
So just one other thing before we move on to the next story. Have you seen any data, or do you just, I guess, based upon your experience, a lot of people, Neil, you touched on this, think that consumers are accelerating spending to get ahead of the tariffs, and maybe to a certain degree, retailers are accelerating promotions to try to, I guess, get consumers before some of the tariff impacts and maybe other just kind of economic issues start to hit in the fourth quarter. Do you have any ability, because, if that's true to a significant degree, then you would expect as we get into October, let's say, that there could be a pretty significant dip because a bunch of sales just got moved forward by several weeks or a couple months. Any data or any sense of how significant that might be?
Yeah, we have looked at it, and there definitely is a pull forward of spend. I think it's very difficult to be absolutely certain about it because the only way we can do it is by asking people, have you pulled forward this spend? And people are never terribly accurate at, answering completely honestly and apportioning money. And of course, people may pull forward some spend and then may continue to spend. So you can't really tell. But definitely from our surveys, there is, on bigger ticket items, especially electronics, furnishings, there have been a number of people saying, look, we probably needed to buy this year anyway, so we have bought it in the first half because we fear the prices are going up. Obviously, for everyday things like apparel and food, it's much less because I don't think they don't want price rises, but they don't really fear them because it's a lower ticket purchase. So I think it's definitely present. And as I said, the August numbers were interesting because there was also some evidence, admittedly, again, from our surveys, not from anything we can actually quantify with absolute certainty. There were people saying, well, we did order things to get ahead of de minimis ending and getting things into the country. So again, that's a form of pull forward. So even if you take it as a very small impact, it's probably not going to be there in the second half, which might lead you to believe that there is a bit of a slowdown that's coming. Still growth, but maybe just at a bit of a slower pace.
Yeah. Sucharita, anything to add on that?
Yeah, I think to Neil's point, this is such a complex set of equations. I think that what we've seen evidenced is that there actually hasn't been a huge impact of tariffs on the American consumer yet. There's a lot of speculation by CEOs and companies that want to say, oh, we're going to pass things on. Beware, everybody, kind of brace yourselves. But we actually haven't seen the tariff impact because in many cases, they keep getting delayed. So, we actually haven't seen a significant impact. Added on top of that, companies have already been stockpiling, adjusting supply, changing their sources of distribution and production for years, honestly, since 2016. And so there may be certain categories like the toy industry in Q4 that may be affected by tariffs if they happen to have shipments in the next few months. But most of them already have stockpiled. And oh, by the way, people have been declining in their purchase of toys anyhow. So it's hard to tell, kind of for years now. So it's hard to tell how much of it is due to, kind of any price differentials. American consumers typically have so much choice that they often will tend to, kind of substitute. You may have certain categories or certain sub items like avocados, which may face some tariffs, possibly, which I don't think they actually have, but even if that were to happen, consumers would switch to something else anyhow, that, kind of may in the aggregate end up not being reflected as a higher basket of consumption. So, which is how inflation, well, there are different ways that inflation is calculated. Some is like going out and doing price checks. Others, kind of looking at spend data and seeing what consumers are actually spending. And the looking at how consumers are actually spending is probably a better estimate of what is the impact on your on the consumer pocketbook. So there are certain categories like steel that, yes, have had tariff impacts for some time, but most consumers and most businesses don't purchase steel products all that frequently. So the impact is often lagging. So it's still, there's a lot that is very complex. And that is part of the reason that I don't think we can easily say it's going to have such a big impact in Q4, or that it will have any impact at all that is that noticeable in the near term.
We'll be right back with the latest installment of The Analysts right after these messages. Promotional support for the Remarkable Retail podcast is provided by Crave Retail. What's retail's biggest blind spot? The fitting room. A shopper wants to buy, but can't get the help they need. That's why global brands partner with Crave Retail, the market leader in smart fitting rooms. Crave connects that moment to your business, giving shoppers a voice, associates real-time alerts, and teams the data to buy smarter. The result? Higher conversion, better decisions, a seamless experience. Learn how fast you can elevate your fitting rooms at craveretail.com. If the world has changed so very, very much, why have so many organizations changed so little? As the pace of disruption accelerates, leaders need the courage and the insight to aim higher in the value they deliver, move faster than they ever have before, and take the bold action to leap ahead of the competition. With Leaders Leap, Transforming Your Company at the Speed of Disruption, Steve's latest breakthrough bestseller, you'll discover why so many companies fall into the trap of the timid transformation. More than anything, you'll learn about the essential mind leaps leaders need to make to win the future. Leaders Leap is available just about everywhere books are sold, as well as on Audible and as an ebook on Kindle for just $9.99.
All right, well, let's move ahead. So these next couple of things we're going to talk about, they're not so much news of the week, but they are topics that have been in the news more recently. And as we've talked about on the podcast numerous times, but we thought this would be a good chance to kind of step back and get a bit of a recap, but also both of your perspectives. There are quite a few iconic brands that are in the middle of turnarounds. Some of them have been in turnaround mode for quite some time, I guess you could argue, but Gap, Target, Macy's, Kohl's, Victoria's Secret, Starbucks, and others. And many of these are probably being somewhat complicated by the tariff situation, but maybe that's something you can weigh in as well. I guess starting with you, Neil, are there any turnarounds in particular you're keeping an eye on? And I guess any sense of optimism, any sense of dread when you think about those?
Well, I'm going to start off with something that will probably make me very unpopular with certain people, mainly the people that work for the company. And it's what I call the turnaround that never happened. I have to give credit to Kohl's. They did a wonderful job of spinning their latest results as being highly successful and as a sign of turnaround. But I'm very sorry, I don't call a 4.2% drop in comparables off the back of a drop in comparables the year before and the year before that and the year before that and the year before that, producing a 19% drop in sales since 2019 when the whole of retail of the things Kohl's sells, to Sucharita's point, has grown enormously by about 30%. So the delta between the two is enormous. I don't really call that a turnaround. And the other thing I would say is, turnarounds do take time. We have to be fair. You don't see the results immediately. But you do start to see things coming through on the shop floor. And I'm afraid I don't really see anything coming through on Kohl's shop floor to suggest that they're making progress. Now, they are talking about private labels. They are talking about doing a little bit more with jewelry, which frankly is a drop in the ocean, but it's kind of interesting. But it's not really showing up on the shop floor. And of course, that's what the customer sees and that's what drives the numbers. So I'm really not confident about Kohl's. I wish them well, and I hope they do start to make changes. But I was quite shocked at how people leapt on those numbers as some kind of great result. Because to me, I just thought it's another really pretty bad quarter.
To be fair, Neil, when you're in a plane hurtling towards the ground and you start to pull out of the dive a little bit, that is a measure of progress. But it also may mean you just hit the ground 30 seconds later. So there.
Yes.
Or the mountain in front of you, right? That's the other challenge for some of these folks.
All right, this is getting very bleak. Sorry.
Take what you can. But then contrasting with that, Macy's. Now, Macy's results, they were good. I mean, they weren't fantastic. And again, you have to say this is, after a long period of decline. But the credit that I give to Macy's is that actually you can see progress on the shop floor. I mean, it's not revolutionary necessarily, but it is progress. And they are starting to do the right things, and they're thinking more creatively, and they've put more investment into some of their stores. And so they kind of get a tick in the box because they're talking about reinventing, and they're actually doing some of the things that are needed to reinvent. Now, whether these numbers continue, the positive comps, is open to debate. But they have produced some pretty solid numbers, and they're getting rid of the dead wood from older stores. And there's a sense of momentum there. And it's the same with Gap. Again, the numbers are not toppy. They're actually quite weak in terms of comparables, but you can see them starting to edge forward a little bit. And so there's hope that the momentum could pick up. But I think with both Macy's and Gap, they're very early on in these turnarounds. And as I said, it takes a long time to deliver. So we need to give them, more quarters, more years to see how this develops. But there is a sense that they're starting to increment things forward, which makes it more interesting than the positions they were in, 2, 3, 4, 5 years ago.
One quick follow-up. Is the tariff turmoil a speed bump, or really could become a big inhibitor to turnaround because of, lack of pricing power, and many of the department stores face the tariffs directly? Any quick thoughts on that?
Yeah, I think it is a problem. I mean, Gap, despite having reasonable results in the sales lines for the past 2 quarters, Gap has had really negative reaction in terms of its share price, simply because they've said, look, here's the impact of tariffs, and it's going to take a massive hit to the bottom line, which is understandable. But again, it does show that they can't necessarily pass all of that across in full because the consumer won't bear it, which is a sign maybe that the proposition isn't strong enough to push through those increases. Macy's, the interesting thing with Macy's, I think the same thing applies. And actually the one fly in the ointment that we got from the latest results is the sales numbers looked okay. But if you look at the profitability, a lot of the profit is being driven by the credit card revenue. It's not really being driven by the retail operation. And there are exceptionals and there are costs in there related to the turnaround. So over time, maybe that rebalances. But to your point, Michael, if tariffs bite, take away some further margin, that pushes Macy's further into that negative territory for stores in terms of profit, which is worrying from a turnaround perspective.
So, Sucharita, you have 1 or 2 brands that you're particularly focused on or have some interesting thoughts on?
I mean, well, certainly I think that there are so many issues with the department store sector, which are systemic, that, certainly everything that you discussed from a macro standpoint doesn't help. In terms of what we are seeing continue to thrive, it does appear that there were, in spite of a few bad quarters, like in the last year, the dollar channel still continues to be pretty resilient. The mass merchandise or, kind of multi-category, multi-brand for the mass, with the exception of Target, which has operational, and executional issues like Walmart and Costco, are thriving. And one could argue maybe their stock prices could be, kind of maybe a little bit softer than what they could or should be otherwise, especially given that they're where consumers are fleeing to. I think there's still a lot of questions as to what happens in some key brands in the apparel sector, like a Nike. There's been so much speculation about their challenges, and they've had a lot of executive turnover. They've faced so much competition, but at the same time, when you look at the numbers that their competition is actually releasing, a bit of ankle biting. It's a bigger question of, kind of how, are there other executional issues that may have inhibited Nike that it needs to kind of pivot back to greater distribution, which may have been, something that they leaned too heavily into around the pandemic. time period. So anyway, Steve, I don't know that I succinctly answered your question, but I rambled on.
No, it's just interesting. I think, I guess one thing I'll comment before we move ahead is, and I guess I'm very much affected by my time at Sears, is, when your momentum starts going in the other direction and consumers start to see you as not winning in the market or have whatever concerns, I think it's just so hard. I mean, you can fix, what I worry about is, yes, you can fix the execution and that makes you better. But my experience has been consumers don't fall in love with a brand, give you high NPS scores, and they tend not to switch from brands they become accustomed to concentrating their spending just because you're a little bit better. So anyway. All right. Well, it would not be a retail podcast, particularly with some folks with your perspectives and experience, without talking about AI just a bit. It's one of these topics that I feel like we either shouldn't talk about at all or we can risk talking about way too much. So we'll see if we can find a happy medium here. But Sucharita, obviously, where you work, you're spending a lot of time looking at technology, the impact of technology. And, when I see some of the news that's been out in the last few weeks, I mean, we've got just like these incredibly high valuations of some of the companies, NVIDIA and others that are involved with AI. But we're also starting to see some reports of maybe some of the AI efforts are not generating the type of results that perhaps retailers would like to see, or maybe it's coming in the form of efficiency and job elimination, not necessarily effectiveness. Any perspectives on what you're seeing?
Well, there's a lot to, oh my goodness, you could, probably talk hours about any part of the AI ecosystem. So I'll try to limit it to the impact that retailers specifically have seen or are seeing. I think that, it is, not facetiously that I say, that we say that there's literally the letters AI in the word retail, AIL, right? Retailers have used AI for decades. AI is not new. AI has been leveraged from a machine learning standpoint in every part of retail, whether it is inventory planning, pricing, store labor allocation. It has been integral to the success of large retailers for a long, long time. What is new is, some of these generative AI applications. And the truth is that those are less clear in what the value is to a retail operation at large. There are some employees that have found that their day-to-day job can be made a little bit better with, like, for instance, generative code for IT workers or marketers with some ability to customize your marketing messaging that you distribute in various digital channels and platforms. So yes, there's some benefit there, but it hasn't yet proven to flow through to either top line or bottom line in any significant or substantial way. So enter stage left, this concept of agentic AI, which really exploded in the last, maybe year or so. And what is that? It is essentially just another version of old AI, just with stitching together disparate data lakes and different systems. So as before you used AI for a pricing solution, now you're able to use the AI from the pricing solution and match it to inventory availability or, an order management system or labor in store. And that's not a trivial thing. It's great. It's good. We should see improvements. But all of these things are incremental additions that in a hyper competitive retail environment just really enable retailers to kind of keep their heads above water. It's not necessarily something that kind of is completely transformational for most retailers. The big footnote to that is, Amazon has had like leapfrogged, kind of volumes of data and AI since it's the inception of its business, and arguably that entire world of kind of automation from an Amazon standpoint has what's enabled it to be as large as it is.
Let's shift gears, kind of our final big story hot takes. We're starting to get, I think we've got a couple more that'll probably come in, the holiday forecasts. And so far we've seen Bain, Deloitte, eMarketer, I think a couple of others. And I would say overall they paint a picture of a weaker holiday than last year. But as we've kind of alluded to earlier, we've had some pretty good years. The 10-year average for holiday sales increases is 5.2%, but that includes a couple of those really boom years that we talked about earlier. Last year, just for comparison, was 4.5, so pretty solid holiday. This year, Bain's coming in with about a 4% increase, so a little bit below what we've historically seen most recently. Deloitte's in the 2.9 to 3.4% range. And then the party poopers at eMarketer, they are predicting only a 1.2% increase. I know your colleague, Sucharita, Brendan Witcher, has gone on record, including on this podcast, of saying he doesn't put much stake in most of these forecasts, and that holiday sales are always pretty good, regardless of what people say, because people will find a way to buy gifts, Christmas, Hanukkah, whatever gifts, one way or another, if that means they have to spend less on something else. But anyway, that's a big wind up to, let's start with you, Neil, getting your perspective, since you obviously take a look at a lot of this data and have a pulse on many things going on in consumer and retail. What's your view of what we might expect for the fourth quarter?
Well, I think the number will be positive. I think that's the first thing to say. The only time in recent memory when holiday sales have been negative was in 2008. And obviously that's because we had a global financial crisis. We're not in that state at the moment. Even if consumers feel gloomy, no one wants to feel gloomy around the holidays. So people do pull out all the stops to spend. I think our initial forecast, I think of about 3.1% growth. Obviously that's value growth. It's not volume growth. So volume will come in under that. Which I think is reasonable. It's very respectable. It is lower than we have seen in recent years, but I think, that's not necessarily because of the macroeconomic situation. It's simply because we are spending so much more now than we used to, and there's so much more volume going through that I think there are limits as to how much people will spend additionally. Right. But I actually think the wider and the more important point is not necessarily what the overall number is, significant though that is, it's who takes the share of that incremental growth and who takes the share of overall sales. And there I think we could see some polarization, as we've seen across the whole year, but it could actually become sharper during the holiday periods. And of course, the other thing that's thrown into the mix this holiday period especially is what the profit looks like, because to Sucharita's point, the first half was kind of all right for tariffs because they weren't really implemented. They have started to bite now. That does affect some holiday inventory, although some retailers have tried to bring things in before. So the pricing environment is much more complex. So I think looking at the share gains or share losses and the margins is probably the bigger picture than just looking at the overall growth rate.
Sucharita, what are you seeing or expecting?
Yeah, Forrester should be releasing its holiday forecast in the coming weeks, and our numbers are probably a little bit more on the optimistic side, in part because the consumer is still resilient, and whatever numbers you may have seen leading up to the holiday season, typically the holiday season does a little bit better. So, kind of, even though, finance executives will always say past performance does not indicate future, future performance. I do think that near-term past performance is usually a pretty strong indicator of near-term future performance. So I think that we're in a period of relatively positive momentum at this point in time, and barring, any type of a global catastrophe or, something unforeseen, if we continue to be steady state, we we should see a decent holiday season that is reflective of the year-to-date growth and probably even exceeds that that we've seen organizations like the Census report so far.
All right, well, let's pivot to what each of you think was the story that people were talking about, or maybe should be talking about, literally, as we like to say, remarking upon, or Seth Godin, or all of us like to say. So I'll ask each of you to weigh in. Sucharita, I'll start with you. What is the story that people were talking about the most in the most recent time frame?
Well, all of the things that that you guys have already talked about. I mean, certainly we continue to get asked ad nauseum about AI, and there still are concerns about tariffs and the state of the economy. I think that those are by far some of the biggest questions. And then I think that even within AI, there's the bigger existential question of what does it mean for jobs? What does it mean for our futures? I think that there is and that may be something else that's actually weighing into consumer confidence as well, which are these worries, these existential threats of what will happen to my livelihood, what will happen to my family, what will happen to my life in the future, which are valid concerns because we just don't know the answers, and we have a lot of speculation from people who are also trying to sell the very products that may be displacing people.
Neil, what remarkable thoughts do you have on this topic?
Yeah, so one of the things I think that's been interesting this week is Amazon's announcement that it is going to help with fulfillment for Shein and for Walmart. So basically, sellers on Amazon and sellers on other platforms can use Amazon stock to fulfill orders from other platforms, and Amazon will do some of the fulfillment, although in the case of Walmart, it won't do the last mile fulfillment, so you won't get a Amazon van bringing your Walmart parcel. I think this is interesting because for a couple of reasons. I think the first thing is it kind of reveals the way Amazon thinks, which is not always the way that traditional retailers think. I think Amazon is very agnostic about some things, and it just wants a bite of the pie, basically. And it makes sense. Walmart's marketplace is growing. Shein has gone away a little bit because of the ending of de minimis, but it certainly hasn't gone away completely, and it will probably come back more strongly. And it's better for Amazon to be in the mix of that, getting a cut of it, than just purely competing. But the other thing that I think it underscores to a certain extent is that Amazon really, because of its investment in logistics and infrastructure, really has such a lead, even on a player like Walmart, which is fantastic with logistics, just because of its reach, its capability, and its speed, that actually it does make a lot of sense for these other players to use to use Amazon as they would kind of a traditional carrier, if you like. And I think it shows the degree to which Amazon has built that network really successfully. And it's interesting because people do tend, I think, in retail to think a little bit more about partnerships these days than they used to, whether it be partnering for brands, partnering with logistics, partnering with pop-ups, because the environment is very tight and everyone wants to get a little bit of an edge or a little bit of an advantage. And sometimes partnering is the most sensible thing. So I found that very interesting.
All right, Steve, what's your perspective?
Well, I'd like to generally have these remarkable stories be a bit more positive, but this is also a little bit about kind of what's on my radar screen, which is I'm not sure a nice way to say it, but the cluster situation at Saks Global, which I have a particular emotional tie, as listeners will know, having worked at Neiman Marcus. It's really quite remarkable that this deal, not remarkable, I guess, that it got done because it's been in the works for many, many years. I mean, I worked on this sort of deal a couple of times over the past 15 years, but how much trouble this company has gotten into. Some people on social media might have seen that I was very skeptical when they said they wouldn't be closing any stores. They've already announced closing 2 stores, both of which happen to be here in Dallas, and neither of them have the issue of being an overlapping location with Saks, which I think is really where the opportunities will unfold in the future, assuming they can stay out of bankruptcy. But the other news as we're recording this is that Bergdorf Goodman, which is owned by Neiman Marcus and now is apparently up for sale, which may be the only thing that's going to keep them out of bankruptcy, because I know a little bit about the valuation of that business, and that would be an opportunity if they can sell it, which I suspect they can, to get quite a lot of cash in. But I think there's a lot of complexity here for a bunch of reasons, which is a different podcast episode. But anyway, I think this is a very fast-moving situation that is unfortunate. And actually, Neil, I'll just tie it back to something you said about Kohl's. I've been in various situations, as probably many of us have, where we try to tell the best story we have with the data that exists. And, poor Mark Metric has to go out there making it sound like everything is great to try to keep vendors shipping when I think, broadly speaking, people know things are, let's just say, less than great. So I do feel for people, and I do hope, just as I do with Kohl's, that they will figure something out. But it doesn't look great at the moment, unfortunately.
I'd weigh in with this thinking about de minimis, and it's come up a couple of times. Often it comes up in the context of Shein or Temu or whatever, but it feels to me like a consequence, like one of the first consequences of all the trade talk and all the tariff talk has been de minimis, really, to consumers. They're getting packages and suddenly they're getting extra fees. It's not as easy as they used to be. Does that awaken everybody to the future consequences and get them thinking about the actual implications in their lives about tariffs, positive, negative, or otherwise? So that's what I was thinking about. Is something that is remarkable. All right, Steve, throw it to you. Pass the mic. Bring us home.
Well, before we wrap, the one other thing we just wanted to touch on real quickly is what's on each of your radar screen. If we take kind of a peek around the corner, what news are you paying attention to that you think our audience should perhaps be dialing up their focus if they want to be responding to what's going on? Sucharita, you want to give us your 2 cents on that?
Well, I think that in this era of uncertainty, I think just being on top of every announcement and every development, I think is really a good thing, whether it is, kind of retailers specifically and their earnings calls and, trying to parse through specific terms or specific expressions or innovations or concerns that they may have. And then also just being on top of, kind of some of these AI leaders, whether following their Substack newsletters or their posts on social media. I think that is as much as we all can do, and continue to use as many of the free versions of these tools as possible, just so that you can understand what is happening and what could be potentially influential or new that maybe had been a laborious execution in the past.
Just a comment on that. I feel like in the last year or two, it's always been true. I think that it's a good idea to stay abreast of whatever's affecting your industry. But I feel like there's so much uncertainty, which I think forces you to try to figure out what you can actually do something about, or whether that's just the state of affairs, as well as things are moving so quickly, just to try to invest more time in staying on top of things. I think that's a great point. Neil, what would be what's on your radar screen?
Well, I think there's such a lot to look at, but I think one of the things that we're keeping a very close eye on is just some of the macroeconomic numbers. So looking at inflation, because do tariffs really start to bite and push up the costs of things in this back half of the year? I don't think we have enough evidence that it's solidly coming through, or whether, of course, retailers are absorbing some of it into margins, which is probably likely in some instances. And we need to see how that balance plays out, but also looking at things like the jobs numbers as well. I think those are really important, obviously, because they can have a direct impact on people's spending ability. And of course, within the jobs numbers, the hiring numbers for holidays, to see where retailers are landing on that. We've had some of them at the moment, but it will be interesting to see whether the hiring is as extensive as it was last year, or whether retailers are trying to keep a lid on costs. So that's interesting. And of course, we have had an announcement on interest rates. It's not a massive cut, but it will be interesting to see the impact, because one of the things that's held some sectors back, especially home improvement, is a kind of sluggishness in the housing market. The transactions are down generally. And actually, it would be a great unlock for some sectors if housing activity picked up a bit. I'm not quite sure this interest rate cut does it, and I'm not sure it's quite timed right, because housing transactions tend to drop as we go into the holidays a little bit. The activity goes down. But it'd be interesting to see where that lands as we go into the new year.
Yeah, just a quick comment on that, not to turn this into a macroeconomics lesson or whatever, but I think I do see a lot of times talking to people that there's a confusion about, that's a short-term interest rate, right? And so you've got, that affects home equity loans, but it doesn't necessarily affect mortgage rates, right? So as you start to get out further, leases, financing rates more tied to the 10-year note and so, it's really, I think, the yield curve that will be interesting. And it's a movement, obviously, in a loosening. But I think even if we get a few more interest rate cuts, it doesn't necessarily mean that long-term rates, particularly given what's going on with the deficits and other factors. So at least it's a step towards a loosening. But the degree to which it's significant in the near term, I think, is very much up in the air.
Yeah, it's interesting because in the US, it's very different to the UK, because a lot of the UK is variable rate. So after 5 years, you'll come off a fixed rate and it's variable. Right. So it has a real direct impact on people's, spending power. Obviously, the US is very long-term fixed rate. So I think, to your point, Steve, it's often the delta or the gap between the interest rate you've got if you're in a house and the interest rate now. And of course, that delta is still big, and that deters a lot of people from moving, because they just don't want to go onto a higher rate if they have to refinance. So, to your point, even if you have a few more cuts, the delta is still going to be pretty big, because obviously we had those low interest rates for such a long time, preceding the latest round of hikes. Yeah,
I think they in the industry they call it rate locked, right? People are kind of rate locked in the homes they're in. So smaller, not larger renovations, all kinds of repercussions. I'm thinking right around the corner, October 31st, one of my most favorite days of the year, Halloween. How many more giant skeletons can be on lawns in North America? What a phenomenon. Just when I think, I've seen the craziest stuff, now we got even crazier stuff. So anyway, congratulations to that one merchant at Home Depot who came up with that idea.
Also, it's the retail circle of life. I just saw driving close to me in Dallas. I saw that a former Office Depot location is now a Spirit Halloween location. So that tells you all you need to know about the state of certain retail site vendors.
Spirit.
Pop-up stores and Halloween.
Yeah. My goodness. All right. Well, listen, a barn burner episode of The Analysts. And thank you, Neil and Sucharita, for joining us. Thank you so much for lending your insights. It was great to spend time with you and give the listeners a sense of what you're thinking about. It's a dynamic industry, and I imagine things are just going to get more dynamic-y. So we look forward to catching up with everyone, and thanks once again for joining us.
Thanks very much.
Thank you.
Thanks for tuning in. To help more retail leaders discover the industry's leading podcast, please drop us that 5-star rating and review on Apple, Spotify, YouTube, or wherever you enjoy your pods. And for more on my strategic advisory services, keynote speaking, best-selling books, and even more retail industry insights, go to stephenpdennis.com.
If you are a brand or service provider looking to take your influence to the next level, reach out to us for sponsorship, advertising, or event partnerships. And if you want to learn more about my own keynote speaking and advisory practice, reach out to me via LinkedIn.